So moving further, so throughout June, prepaid rent carries a balance of 3,000. At June 30, adjusting entry is required to transfer 1,000 from prepaid rent to rent expense. And now, because you pay the 3,000 in advance, 1,000 you consume, 1 month rent you consume, right? Entry would be the rent expense to prepaid rent, right? Because you created the rent and rent is reduced by 1,000. So when you post the entry here, so prepaid rent 1,000, and when you see the balance, so prepaid rent balance reduced to 2,000, and rent expense has occurred. So rent expense increase always debit, right? So expenses and revenues, they are part of retained earnings, and also dividend, they are part of retained earnings. But the treatment for dividend and expenses are that when expenses or dividend increases, it is debited, right? We discussed in our previous lectures. The second category of the prepaid expenses are supplies. So let's continue with understand this with example here. So on June 2, Freddy's Auto Incorporation service paid cash 7,000 for cleaning supplies. So what will be the entry? Entry would be on June 2, supplies to cash, right? Because you paid cash for supplies. Supplies increases, supplies is our asset, supply increase debit, and cash decrease, asset decrease, credit, right? So you post the entry, this is the account name, you post the entry, supplies are debited by 700, debited 700, credited cash with 700, 700 is going to be at the credit side, right? So now account at June 30 indicates that $400 of supplies remain on hand, which means 300 we use that one, right? So our supplies assets, which was 700 before, is reduced to 400 right now, which means 300 is used. So entry would be expense to, because expense rises, so supplies expense to supplies, this supplies, okay? Supplies expense to supplies, right? Asset decrease, credit, expense increase, debit. So that's going to be our entry. When you post that entry, our balance becomes 400, which is 400 here, right? Since we use expenses, expenses are debited, so usage of supplies will become expenses. Expenses increase debit, we post it on the ledger as supplies expense to June 30, 300. So here is a practical example for you guys. Just stop the video right now and think about it and try to solve it by yourself, and then we solve it together. Okay, at the beginning of the month, supplies were 5,000. It means we have a beginning balance that is 5,000. During the month, 7,000 of supplies were purchased. It means extra new supplies were purchased 7,000. At the end of the month, 3,000 of the supplies are still on hand, which means the ending balance is 3,000, right? So how much you consume during the month, we don't know. Right? So you are required to make adjusting entry, ending balance of the supplies account, which we already know that, which is 3,000. So 5,000 plus 7,000 is 12,000, and how much we use? 9,000. That's how equation is completed, right? Okay, let's see the solution here. So we use the supplies. So adjusting entry would be how much use? 9,000. So 9,000 would be supplies expense to supplies, right? Supplies expense to supplies, 9,000 debit and 9,000 credit. And ending balance, we already know that is 3,000. So ending balance on hand is 3,000, right? If you don't understand that, please do write us on our WeChat group, and we will try to discuss. If you don't understand that, then we try to have a Zoom conversation. And now moving towards the depreciation of plant assets. What are the plant assets? These are long-lived tangible assets such as sorry, land, buildings, furniture, and equipment. So all plants except land decline in usefulness, and this decline is as an expense, right? With the exception of land, because the value of the land appreciates with time, right? Other than land, their usefulness decline. We have to record the decline is usefulness as a expense, and we spread it over its useful life. So plant assets are recorded as when they purchased. So let's explore this. So we have an illustration here that suppose that on June 3, Freddy's Auto Service purchased equipment on account 24,000. What is the entry? Entry is equipment on account, which is accounts payable. So on account means that you did not pay cash, you create a liability. So when you, this is a journal entry, when you post it to the ledger or post it to your petty account, it will be like that. So the next one is Freddy's equipment will remain useful for 5 years and then be worthless, which means after 5 years the value of the equipment will be 0. So on one way to compute the amount of amount of depreciation for each year is to divide the cost by expected useful life, which is 24,000 divided by 5 years. That would be our per year depreciation, right? Which is 4800. So let's see that. So this procedure called the straight line depreciation method. There is no hard and fast rule in there. Just divide the cost with the number of useful years. So we have, let me just delete that one and see the solution here. That is 4800 per month. So monthly depreciation would be, you divide 4800 with the 12, so 400 per month depreciation is recorded. And now how the depreciation is recorded. So we create accumulated depreciation account, and from month to month we charge depreciation to this contra account of the contra account, which is called account depreciation. So the accumulated depreciation of equipment is basically credited to preserve the original cost of the asset in the equipment account. So managers can then refer to the equipment account if then ever needed to know how much the asset is actually cost. So we don't basically deal with this equipment stuff. We create a new T account, that is accumulated depreciation. Let's see the solution here. Let me just remove that. So June depreciation would be depreciation expense to accumulated depreciation, right? So if you see that here, we are not disturbing the equipment. Why? Because equipment is recorded on its purchase price 24,000. We created accumulated depreciation. Sorry. So when we post that, 400 and 400 are here. So the equipment original account is not disturbed. So the logical question that should pop in your mind is that why there is a need of a cumulative depreciation account. So cumulative depreciation account shows the sum of all depreciation expense. The balance increases over assets lifetime. Is a contra asset account a normal credit balance? So what is contra account? A contra account has two distinguished characteristics. One, it is companion account. Its normal balance is opposite to that of the companion account. For example, the 2 months depreciation would be 400 multiplied by 2, answer is 800. So the equipment cost 24,000. So it will be written as accumulated depreciation 800. That is the net value of the asset, which would be 23,200. Right? So we just discussed how we're gonna write the accumulated depreciation account. So the exhibit 3.4, it shows that one. So we have partial income balance sheet statement of credit service. So we have equipment, that is 24,000, less depreciation equipment, which is 400. So the book value going to be 23,600 of the plant assets. So the total of the assets include 41,600, right? So the accumulated depreciation is a contra account. Contra account is a companion account of the equipment plus its balance is opposite to the equipment. So if equipment is positive, its balance is negative. So the in accounting, when we read negative is exactly equal to minus 400. Okay, in accounting, when you write it down in statement format, minus means this bracket. So the question is, what will be the book value of Friday's equipment at the end of July? Right, at the end of June we have depreciation 400. So at the end of July we incur 400 more accumulated depreciation. So that will be added here as well. So it would be 24,000, and then we have 800. Answer would be 23,200. So let's see the answer here. Here it is, right? So the July answer would be, this would be replaced with this. So this exhibit 3.5, it shows how Starbucks Corporation reports property, plant and equipment in its September 30th 2012 report and October 2 2011 report. So line 3 to line 9, which is line 3 to line up to line 9, it specifies the assets and their cost. Land 46, building 225, leasehold improvements, store equipment, roasting equipment, furniture and fixtures, work in progress, right? So line 10, which shows the addition when you add all those assets. So your total, let me just remove it. So your total is 6903 is your plant, property and equipment gross. While line 11, it gives you the accumulated depreciation, which is 42,400, which is a companion account of the plant, property and equipment. while the line 12 it shows the net value of the property, plant and equipment, which is 2659. Right? This is how Starbucks Corporation reports its plant, property and equipment.